Hey everybody, my name is Brandon from thestockstreams.com, and today I want to talk about FSLY stock, ticker symbol FSLY, and how it is down over 47% in about 6 months. What we're going to do first is go into Google and talk about the macro picture of FSLY before going into the earnings report to talk about how FSLY is doing as a business, and then we'll go into the trading charts to see if there's a level or two to buy FSLY if we want to buy FSLY. So now let's get started. So here we are in Google, and here's a 6-month view of FSLY stock charts here, and we can see that we are down more than 47% in about 6 months. So if we look at the news down here to try and figure out why FSLY is down so much in 6 months, we can see that we actually have some differences in opinion from the journalists here. We can see that there are some bearish articles here, but also we get some bullish. So the question is now, why are reporters a little bit uncertain at whether to be bullish or bearish on FSLY? And this is likely because of a mix between the bullish macro picture of digitalization and cybersecurity with the mix of the caveat of the fundamentals of FSLY. And this is particularly shown in the CNBC piece, where investors were a little bit spooked by the drop in revenues because of an outage where FSLY basically took down half the internet in a day. This is likely one of the reasons why the stock has fallen. We'll get to the revenues part in the next section of the video, but in the macro world view here, I want to talk a little bit more about this outage, and to really understand what this outage actually is and why it matters, we first have to understand what FSLY actually does as a business. So again, we'll move quickly through this, but what FSLY actually does is a form of cloud computing, which they call edge computing. FSLY has a couple products that it offers, but I think the product that provides the quickest explanation for what FSLY does is this managed CDN, or managed content delivery network solution here. This may be a little bit technical and a little bit nerdy here, but bear with me as we go through this example here from Lise Webb. So following Lise Webb's diagram here, imagine that you have a video that you want to share with the world, and that video is stored on a server in Europe. Let's say that's Italy. However, let's also say that you have more friends than I do, and you have friends in Florida here and in Texas, and you have friends in Russia, and you also have friends in the Philippines over here. And all of these friends want to see your video. If you do not have a CDN like FSLY, then basically all of your friends here are basically making requests to your one server in Italy to pull your video from this server and deliver it to your friend. Because there are many people that want to see your video, all of these requests from your many friends are slowing this one server down. Not only that, of course it takes time for that request to go from Texas here to your server in Italy, back to Texas where your friend watches your video while riding on their horse. These problems is what CDN companies like FSLY tries to solve. They have their own servers here, which I represented with these guys here, that are separate from your main server here in Italy. What these secondary servers do is that they basically cache or temporarily store the important information from your main server here in Italy onto these separate servers here. And these secondary servers are closer to your target customer. What this does is that it lessens the wait time for your request for your friends. So instead of your Philippines friend having to send a request from the Philippines to Italy back to the Philippines, instead, because of the secondary server which cached your main data from Italy, your friend from the Philippines can get the same data by making a request to Indonesia back to the Philippines. So because geographically they are closer together, that lessens the wait time and it does not bog down your main server here. This is why some people say that edge computing is powerful, and as an investor, this is definitely a bull case of FSLY. Obviously, the world will become more digital and the internet will continue to grow. So services like FSLY's here with CDNs, these services will likely be needed to satisfy all customers around the globe. So yes, this is a bull case for FSLY. However, what is even more interesting to me about FSLY is the cybersecurity applications. Now, what I'm about to say is not completely true, but basically if you are a developer, if this is a server that you own here, well, this server can easily be hacked when bad people send requests directly to your server here. However, because your friends are not actually contacting the main server in Italy, they're actually only touching CDN secondary servers from, say, FSLY. This is why your server is quote-unquote safe from hacking, because now it is FSLY's server that is being the connection between the customer and the data. Again, there are asterisks here, but the main point is that your server is safer because of the shielding effect that these CDN servers have. This is another bull case for Fastly because we all know about cyber attacks, so any company that has a solution to increase protection against these attacks like Fastly should benefit over the next few years. However, this brings us to the news story when Fastly basically brought down half the internet in early June. You can imagine that if your customers here are calling these secondary servers owned by Fastly and these servers are not picking up the phone, well, then your customer will not be getting any information. And this is exactly what happened back in early June when websites like Spotify, Reddit, and even Amazon were unresponsive for hours. You can imagine that this was probably not the public relations image that Fastly wanted. So there are two ways to view this. One is the bull case where you could say that a lot of the internet, like Amazon, seems to rely on companies like Fastly to serve their customers. However, you could also say, as a CNBC article says, that Fastly blew it and has lost customers because of this outage. Again, fact of the matter is, it is up to you to decide which camp you're in, but both of these sides have their facts. Another fact is that this outage has definitely impacted Fastly's revenues. So with all that said, let's head on over to Fastly's earnings report to talk a little bit about how Fastly's business is doing. So here we are in Fastly's most recent earnings report for the most recent quarter ending on June 30th, 2021, which is this column here, and this is compared to the same quarter from last year, from 2020, which is this column over here. So first things first, we can see that top line revenues, which is this line on earnings report, is increasing year over year, and that's a good thing. However, if we actually do the math here, we're only increasing by about 12%. For a company that wants to be considered as a growth company, this to me is actually a little bit lackluster. If I was an investor in Fastly, I would want to see growth in at least the 20%, if not higher. This to me is immediately a little bit disappointing. And again, this may be a residual effect from the outage, which caused Fastly to lose some customers. The next thing I want to point out here is gross profits, which is this line on the earnings report here. We can see here that year over year, we can see our profit margins are decreasing. And how do I know that? Well, we see that gross profit for the most recent quarter here is actually less than what we saw in 2020, even though our revenues are actually increasing year over year. So if our revenues are increasing year over year, there's more money coming into the business, but we're unable to keep the extra money. Well, that must be because our cost of revenues is likely higher year over year, and that's what we see. For companies that I'm looking at, I want to see gross profit margins increasing, not decreasing. What this is telling me is that there are some inefficiencies arising from Fastly's business here. Again, this may be an effect from the outages, but this is something to definitely consider if someone wanted to invest in Fastly. Moving on here, as we go on to the total operating expenses here, we almost see a doubling of Fastly's operating expenses, and that is something I don't like to see at all. And, with all that said, shrinking profit margins with increasing operating expenses, obviously that should lead to an explosion of net loss. And if we look at the net loss here, we see an explosion of net loss. We see that this is more than 3 or 4 times the net loss that we saw year over year. We are basically losing about 3 or 4 times the amount of money we lost in the same quarter last year. So to me, this is honestly not the best and not really what I want to see. Yes, if you want to be a growth company, you have to spend money to grow, but I want to see a reward on that spending. To me, the most important thing is I'm not seeing a reward of that spending when I look at the revenues here. Only up 12%, that is a little disappointing, even though we are spending more year over year. So again, just to summarize everything here, we do see growth in revenues year over year, albeit slightly. We are seeing decreasing gross profit margins, and we are seeing increased operating expenses down here. But again, a lot of investors consider Fastly as a growth company. It's up to you to decide if Fastly's 12% revenue growth rate is acceptable or not, and it's up to you to decide if you think Fastly will be able to continue growth at or above this rate for the foreseeable future. But again, to me, the growth is a little disappointing. So with all that said, let's head on over to Fastly's trading charts to see if there's a level or two to buy Fastly if we want to buy Fastly. So here we are in Fastly's trading charts, and we can see that we were once trading in a pretty defined range between the low 60s and the mid to upper 70s before crashing back down after we had our earnings report down to the $40 level. If we look, we were actually able to claw our way back all the way up to $60 before we hit our head at this $60 resistance level made from the bottoms of these candles over here. After being rejected at this $60 resistance level, we kept falling in a downtrend here until our second quarter earnings report, where we fell again down to the $33 level. If we zoom on in here, we can see that we rebounded slightly but maintained the downtrend. So the question is, what happens now? And as always, nobody knows for sure, but I would expect that we might be trading in the range between this $40 to $60 level here. We might wave out in this pretty long range, or we may eventually fall to trade between this $33 support level made from the bottom of this candle here up to where we are right now, around $40. So to me, it's quite a risky stock at the moment, especially because we have this strong downtrend here. I think if somebody wanted to start a position in Fastly, I think right now could be a place to step into a position in case the stock does move back up to 60 by bouncing off this $40 support level. But as always, I would be starting the position slowly. As always, when starting a position as the stock goes down, I would be averaging my way down as well. And if we do see this $35 level again, then that would be the place where I would be filling out the next part of my position. If we look at the MACD here, which is this chart over here, we can see some positivity actually. We can see that our short-term momentum, which is the blue line, is just about crossing the long-term momentum, which is the orange line. This is normally bullish for the stock, as there could be a short-term positive momentum burst to raise the stock. Also looking at the RSI here, which is this chart down here, we can see that we are still pretty close to oversold levels, which is below 30, which again, because of the RSI and the MACD, an argument could be made that around this $40 level could be a decent entry point for the stock. But again, there are risks here. I would be greatly considering the lack of growth and the relatively disappointing fundamentals from Fastly's earnings report, but I would also consider the macro bull cases as well from the side of the continual growth of the internet and the need for cybersecurity. With that said, I would also suggest looking at competitors to Fastly as well, such as Akamai Technologies or Cloudflare, in case you do like the macro story of Fastly, but are a little disappointed at the fundamentals.